Petrochemicals giant Sasol has unveiled plans to spend $21 billion in building plants in the state of Louisiana in the US. The capital expenditure will amount to two-thirds of its current market cap of 260 billion rand. Some investors and analysts question whether the risk involved will justify the return. Analyst David Lurkey joins us in studio to give us his opinion.
Brian, this is David. Thanks for joining us. But a lot of debate going on now with some of the plans now is Sasol unveil exactly what they want to do in Louisiana. You've got a great idea of what they're going to do, and we're going to ask you about that now. But there has been already a little bit of, I guess, a little bit of tension between some investors. I got in touch with Alan Gray today because I know that they'd expressed concern around the size of the CapEx program that Sasol's now embarking on. They didn't want to comment, but what they did do in their equity fund is they just said here, and I'll just read this out: we continue to stress to company representatives the importance of sound capital allocation, which will generate appropriate returns in a wide range of possible scenarios. Sasol is, of course, their biggest holding in their equity fund at 10%. So I think for the benefit of our viewers, just take us through exactly what the company wants to do over the next 7 years with these developments in the States.
All right. I think firstly, remember that it's 7 years of spending. Once you've put a plant up, that takes a long time to build. It doesn't just turn on like your television and work perfectly. It takes a while to build up. So you're probably looking at about a decade from now before you really start seeing returns coming out. That seems like a long time, but it's exactly for that sort of thing that shareholders employ management. What they want to do there is, firstly, they want to put up an ethane cracker, which very simply takes natural gas, which is very cheap in the United States right now because they've been fracking there, and it turns it into plastic. That is really good business right now. There are fundamental market forces that should keep that a very good business for a number of years to come. That's the first one we'll get. I don't think many investors got any problem with that at all. The next step is to do a gas to liquids plant that is similar to in Secunda in South Africa. We take coal and turn it into petrol. Sasol has an operation in Qatar where they take natural gas and turn it into diesel, and they basically just want to replicate that at about 3 times the size in Louisiana.
So these are technologies that they've proven already. They've demonstrated on a commercial scale that they're able to do this. So it's nothing new to Sasol to put these plants up. It's just merely the location that's different at the moment.
Yes, the location is different. For the gas to liquids plant, this is, as I said, about 3 times the size of their operation in Qatar. So it's a lot bigger, and you're using larger reactors. It's more complicated, but certainly the technology itself is proven.
Are fund managers in general waiting for some big value unlock to drive this Sasol share price into the stratosphere?
Very possibly. I think they are in for quite a long wait. As I said,
they've already been waiting quite a long time, haven't they?
Yes, they have. The thing is, if you look at Sasol 5 years ago, it was at about roughly the same price it is now. Of course, the world was a very different place then. We had oil at somewhere around $140. The rand was just as weak as it is now. So, at that point, it was a bit frothy. There was too much excitement in the Sasol price. Over the last few years, it has moved quite nicely forward. But the thing with this business is you don't get the kind of predictability of earnings that you would out of an MTN at the opposite end of the scale, where you've got very stable revenues coming in. At Sasol, you're dependent heavily
on the oil price and on the rand dollar price.
Exactly. So you've got 2 serious variables there. They've got operations all over the world. They do a lot of business in chemicals as well, where the prices move around quite a bit.
David, the risk is obviously it's a lot of capex. I think that the number being bandied about is about $21 or $20 billion, which equates to about 2/3 of their current market cap. How are they going to fund it? And what are some of the things that can go wrong here? Can things go really wrong if they're taking on debt and they're using a substantial part of their operating cash flows to fund this?
And it makes them the single largest foreign investor in Louisiana.
Indeed. I think just looking at things, remember that this is a 7-year program, and it probably will end up being a little bit longer. So yes, the number itself sounds big as 2/3 of the market cap, but it's over a number of years. In any given year, you're looking 10, 12% of the market cap. That's not that dramatic. You saw MTN last week say that they were going to spend 10% of their market cap in this year. So it's not that dramatic from that perspective. Your difference is that there are more things that can go wrong here. Specifically, the whole point of the plant is to have cheap gas and expensive oil. Now, if that closes, you could be in trouble. Right now, the economics look fantastic, and you could double the gas price, keeping the oil price still, and they'd still make a great profit. So that side of it should be all right. These are genuinely complicated things to do, to put up these kind of plants. It normally takes your reactor and your catalyst a couple of years to function perfectly. However, they've done it really nicely in Qatar and grown their volumes there very nicely over the last 4 years or so. The volumes have really grown.
I know you've just released I'm sure, an in-depth report to your institutional clients today who will be reading, and I'm sure with the modeling skills that you have, you've probably had a look at what the balance sheet will look like after all of this. Any guesses on any details around how indebted the company will be, considering now that it's very undergeared? I think it's only got a debt-to-equity ratio of about 2.5% at this moment, so plenty of scope to use debt, and obviously massive operating cash flows. But besides the project, are there other things that are going to be using the cash of Sasol over this period? And are you worried about what the balance sheet might look like at the end of this?
I suppose at the peak of the funding, which is probably going to be in 2016 or 2017, you're going to see the gearing go from, as you say, a couple of percent now, right up to around 40%, which is the upper end of their sort of target range. Certainly my modeling says that if a bunch of things stay relatively civilized, then they'll be just fine. They produce a huge amount of cash every year. They only give around about 40% of that back to their shareholders in terms of dividends. So they've got a lot of cash to play with in any given year. So yes, it will take their gearing up. Will it be terrible? No, I don't think so.
Just very quickly, you reckon David Constable is steering the ship in the right direction?
Yes, I would like him to probably be steering the ship a little faster, and a little more aggressively. What we did see at the results on Monday is that they've kind of strung out this capex by a little bit to put a bit less pressure on the balance sheet. But of course, that means you're taking positive NPV projects and implementing them later, which I don't really believe in.